Hi guys, Joe Mendoza here in sunny San Diego. Welcome to my show. Thanks so much for watching, subscribing. Ladies and gentlemen, we have an incredible guest today. All right, his resume is pretty incredible. He's a CEO of Spartan Investment Group. He's done some flips. He's heavily concentrated on self-storage. All right, a U.S. Army Reserve, Operation Iraqi Freedom veteran. That's amazing. All right, degrees in chemistry, marketing, and a master's in management. Ladies and gentlemen, welcome to the show, Scott Lewis. How are you?
Fantastic, Joe. Thanks for having me.
Yeah, thanks for being on the show and your service. Really appreciate that.
No, it allows me to put on my camouflage PJs 1 weekend a month and 2 weeks a year. At least it did. And we're all using Microsoft Teams now. So hopefully we can figure out how to get the Russians and the Chinese to join Microsoft Teams, and we'll fight them via the internet. So
Awesome. So you're still a reservist now?
I am.
Fantastic. How long in the active, and then how long in reserves?
So 4 years active, and then it will be 10 years in February. So right at the 13 and a half year mark for full service. So
that's fantastic. What's your rank, if you don't mind me asking?
I am a major.
All right. Good stuff. Awesome. So let's jump right in. You ready?
I am. What's happening?
All right. Perfect. So self-storage. This is an interesting one. I've had some fix and flippers here, and I've had some other kinds of guests that talk about other assets. Why self-storage?
So I'll kind of start with, the whole genesis of this, because it's an interesting kind of pivot.
Please do.
We were fix and flippers. We did some individual homes and we did some condo developments in Washington, D.C. And that just wasn't in our blood. We didn't like the residential side of the house. So we decided that we're going to pivot. We're going to pivot into commercial. But what should we do? So tying back to the military that we just talked about, inside the Army, there's something called the Military Decision-Making Process, MDMP for short. And it's a system designed to make complex decisions in kind of unfamiliar environments. That's what it's designed to do. So inside of Spartan, I have taught everybody MDMP. So we use it inside of Spartan to make those complex decisions. At that time, it was the commercial asset class. This time it was how to operate during coronavirus, right? So it's very applicable to a lot of different things that you're doing. So circa kind of October 2016, we made the decision that we are going to pivot. But what are we going to pivot to? So with MDMP, one of the things that you do is you develop various courses of action, and then you measure them against evaluation criteria that you put together early on in the process. So with those evaluation criteria that we came up with were 3: easy to operate, easy to maintain, and easy to evict. Inside of Spartan, we call them the 3 E's. So when we looked at all the different commercial asset classes, we looked at multifamily, office, medical office, cold storage, data centers, self-storage, medical or mobile home parks, the whole 9 yards. We looked at all of them. The one of them that fell to the bottom that most meets the 3 E's is self-storage. And that is why we picked it, because it's just one of those asset classes that is very easy to operate, very easy to maintain. It's a concrete box, right? There's not much to maintain there. As long as your gate's working and not trapping people inside, you'll generally be okay. And then very easy to evict. Right now we're seeing all kinds of moratorium on evictions, which is great for those people in the apartments, but not so great for multifamily owners, right? The bank doesn't care about that moratorium. It's coming for its money. Self-storage, who cares about grandma's old rocking chair that you've had in a box for 10 years? No one. So we're still able to execute our late notices, our evictions, our auctions. And of course, we're taking it into account where folks have been on hard times because of the virus. We're actually seeing a decrease in all of that stuff because people are paying faster now than they did pre-COVID. So that's really why we chose self-storage.
Interesting. Now, how many flips were you up to that you made that decision to pivot?
Very few. So we did by design. So our average return on our flips was, 30 to 40%. We had one of our flips that had 172% return in 12 months. So we, by design, did very, very few deals that had a lot of meat on the bone. The reason we did that was risk mitigation. It wasn't greed. It was the opposite of that. It was risk mitigation. We knew we didn't know what we were doing. So we were only doing deals that had a lot of meat on the bone. So if and when we made mistakes, that our investors' capital and our own capital would be protected within those deals and we could still make a return. It caused us to go a lot slower, but that enabled us to build some of the foundations of the company while doing these projects versus just being so focused on doing the projects that we didn't build any foundations of the company.
Perfect. Thank you. Now, as a flipper, what were some of the different skill sets that you used to your advantage in the self-storage space?
So really, the only really skill sets that were applicable from the flipping side to the self storage side were some of the construction stuff. When we take over these assets, we're not buying core assets; we're buying value add assets. So there are elements of renovations and capital improvement projects at every one of these facilities. That's about the only thing, excuse me, that moved from the flipping side to the self-storage side. The vast majority of skill sets that were applicable across that dynamic were non-real estate skill sets: project management, strategic planning, risk analysis, underwriting. So,
got it. Thank you. Now, the due diligence, I think I read something on your website about a 675-point due diligence checklist. That seems rather extensive. Give us some of the things that might pop out, not the normal things, but some of the different things that like people really should consider working with a pro like you.
So there's all kinds of stuff on the survey side of the house. Mostly, it's actually my chief investment officer and partner Ryan is in a deal in California that is working its way through the SEC. We're pretty sure it's a pyramid scam, but one of the things that was in there was a survey, and the survey, the syndicator just accepted the seller's survey. Well, a survey contains all kinds of information that if you don't know what it is, it can either be very valuable or incredibly risky for you. So our due diligence process talks about all the different points of a survey: easements, encroachments. I don't even know. We have attorneys now that review all of the surveys. And one of the case in point is get a new survey, a couple $1,000. But in the case that my partner was in, that survey from the seller, it looks like it might have been forged, how that trickled down is what they thought they could do on a development based on the survey was actually not, because the real survey was missing part of what they saw. So just having like that checklist to say that, like, does our survey contain all this stuff, easements, like encroachments, right-of-ways, boundary lines, all of that information that's contained on a survey, that's in that checklist. So that's something that's probably very different from the fix and flip folks versus the commercial folks, especially if you're doing an expansion.
Wow. So we're talking a land survey, correct?
Yes.
Okay, perfect. Just for the audience there. Awesome. Wow, that's very important to know these things, because more thorough, the better. I mean, I've seen these different Ponzi schemes. Next thing you know, I mean, they have this high gloss brochure. Next thing you know, they're on the news. So that's really, really great. Now storage. What are the different value adds are we talking about? Because an outsider looking in might like, what kind of value add could you put on a storage facility?
So there's probably, 30 or 40 different areas of ways to add value to a storage, from both operational improvements, expansion, or additional revenue streams. I'll back up to the storage industry itself. It's still approximately somewhere between 70 to 75%, depending on your source, owned by individual operators, otherwise known as mom and pop. When we look at that, almost across the board, when we buy a facility, it's from a mom and pop, somebody that owns 1, 2, 3, 4 facilities. And inevitably, when they get to those, managing these, if you're an individual, is not easy. So we say easy to manage from our perspective, but we've got a property management division inside of Spartan. Makes it a lot easier. So what we normally see is the facilities are not being managed to an institutional level, which leaves a lot of meat on the bone. A lot of times, the mom and pop owners haven't raised rents in, 4 years, 10 years, 12 years, who knows when they've done it. And even if they had, it's almost never to the market rates, because they don't do very good competitive analysis. They listen to their managers, and their managers talks to a buddy down the road, and that's how they do their competitive analysis. So, even a 10% rent increase when we're operating from the valuation of cap rates, a 10% price increase at a 5.5 cap can equal hundreds of thousands, if not millions of dollars of value. That's just one operational improvement. Things like auto pay, set it and forget it, right? Marie Kondo, like get all your junk out of your apartment, put it in storage, set it and forget it. We've got customers that have been in the storage for 30 years. So there's almost an infinite number of ways that you can add value to storage, especially because unlike multifamily or any residential, for the most part, self-storage is a month-to-month lease. So with 30 days notice, I can raise prices. I can do dynamic pricing like the airlines do. If you call me and I have one 10 by 10 unit left, it's gonna be a heck of a lot different than if I have 10 of them left.
Wow, that's great. Now, they talk about rent control in some states, California, I believe Portland, a couple other states and cities. Now, does rent control apply to storage units, or is it state by state as well?
It's state by state, and we wouldn't do business in a state that does rent control.
Okay, so there is rent control existing.
I don't know because we only have a few states that we that we're looking in, and in those states we have not run into it. I don't even know what California does. That's a state that I won't invest in or do any business with. Same with Oregon. So just not the business climate that we would prefer. So a lot of the states that would probably have that are not necessarily on Spartan's radar.
Okay, perfect. So talking about the radar, what are some of your different buy criteria or key performance indicators that you're looking at before making an acquisition or an offer?
Yeah, so mainly it's population and job growth. Those are two things from the environmental side of the house, from the market side of the house. It's job growth and population. Jobs drive population, and population drives storage demand. There's a few other markers as far as rent and whatnot, but it's really about population growth and job growth. It's very similar to other. There's no special sauce for storage versus multifamily or retail or something like that.
Got it. Now, your acquisitions currently, or your recent ones, are you doing JV, syndication? What kind of ways are you purchasing these properties?
Syndication. So we syndicate all of our own deals. We are not a syndicator. We are a sponsor. We just use syndication to raise the private equity from our investor group, which we've got about 1,900 folks in our group and about 250 that are active investors with us.
Very nice. How big is your portfolio right now?
Just over 100 million. We're at about 107 million or so.
Nice. Now, how many facilities might that add up to?
13.
13. Perfect. And what marketplaces?
So we're in Seattle, just outside of Seattle, just outside of Denver, and then kind of a smattering around Texas, multiple markets in Texas.
Great. Now, how are you typically acquiring them? Through brokers, through direct letters to sellers? What's kind of your acquisition model?
The answer to that question is yes. So we have a very robust direct to seller, but we also have some very good relationships with some very good brokers.
Fantastic. Now, could you go a little bit more into your buy criteria? Is there a certain cap rate you want to be at to purchase and exit? Like, what are some of the different other KPIs?
So no real like going in or exit cap rate. Mainly, we're looking at facility size and deal size. We're not really interested in smaller deals. It's just for us, it's a lot of work to buy a 20,000 square foot facility, and it's very hard to manage because most of the time those smaller facilities, anything under about 40,000 square feet, won't support a full-time manager. So for us buying in multiple states, it just doesn't really make sense for us. So we generally look at 40,000 square feet or above. We look for operational improvements, expansion that we can add additional storage there, or other out parcels. We've got a deal now in Texas that has a few out parcels that we're going to be probably building medical office on it. We won't own it, but we'll probably sell it off, something along those lines, that enable us to drive value somewhere else besides the storage. Facility specific, it's pretty across the board. I mean, we're pretty flexible buyers. That's one of the things that we like to. We're pretty adaptable and we're pretty flexible. So far we're 100% contract to close rate. So if we go to contract, we've ironed out most of the issues that we're going to find. And if there's a major one, it's generally just sitting down with the seller and the brokers, if it's a broker, or with the seller, and just kind of working out like, hey, what makes sense here? Here's what we found. Here's the issue. Here's a couple different courses of action as to ways to correct it. Beautiful.
Now, your team, it looks pretty big. Somebody goes on your website. What do you specialize and who's doing what? I mean, you've got a pretty big team. How many on there?
Yeah, so we've got 12 at our headquarters, and then we've got another 14 in the field that are managing our facility. So yeah, Spartan's at about 26 people right now. And me specifically as the CEO, I'm more of this strategy and strategy and corporate level operations guy, and engaging kind of with other CEOs. That's mainly my purview, which a lot of people will ask me like, hey, what's your acquisition criteria? I don't know. Why? Because I have a really good acquisitions team that's in it day in and day out. Or like, hey, what provider are you using for your merchant services? I don't know. My operations team, I could ask Jackie or I could ask Danica, and they could tell you in a heartbeat. But quite frankly, I don't know. And it's decisions that I don't want to have to be making because I'm a big Apple kind of fan in some of the things that they've done. And one of the quotes that I believe came out of Apple is, we hire really smart people and have them tell us what to do.
There you go. I like that model. Good job. Now, these acquisitions, what's the typical hold period? Is it 3, 5, 7? What kind of your typical hold period?
Yeah, our bread and butter is 3 to 5. Okay. That's probably the kind of the 80% catchment. We have a couple of longer ones. The development in Black Diamond, Washington is 10-year because it's raw land development. It was a very tricky development process. So it took us a couple of years just to get it entitled and be ready to build. And then it'll take us a couple of years to get it stabilized. So we didn't want to one thing Spartan never wants to do is we never want to miss expectations. Of course, everybody has the probability of doing that. But we try to balance it to where we really don't go out there too aggressive with anything that we put out with timelines or numbers. That's generally how sponsors get into trouble, is they get a little aggressive on the numbers, and it goes, that's inevitably, everybody's got a plan until you get punched in the face. Well, when you're doing development, whether it's raw land or expansion, you're going to get punched in the face, and you're going to get kicked in the teeth, and you're going to get hit by a bus. So you better plan for those things to happen with your timelines. So we have an RV park in the Permian Basin, which is based on oil. So anybody that's not living under a rock right now understands that oil is not doing very well. So we didn't want to put a 3-year timeline or a 4-year timeline on an RV park that is cyclical in oil, and we don't want to have to sell during the bust to try to meet timelines or be in the position that we can't hit investor timelines. So on that one, we put a 10-year time frame on it that will hopefully give us some boom and bust cycles such that we can sell during a boom and not have to worry about the bust.
Beautiful. Thank you, Scott. Now, out of your just over a dozen deals, acquisitions that you have, which one was the toughest? And how did you get to that finish line?
How do you want to define tough?
From the due diligence to putting it together, structuring, etc.
So probably, I would say that we've got an RV park, Goldenrod RV Park. That was, it was interesting in the way that it was tough on the financing side of the house. Because it was our first RV park, it was in the Permian Basin, and it was a mess. I mean, it was a disaster. And it was a disaster really because of kind of the management prior to it. And it was during a bust as well. So that definitely hit it in the Permian Basin. But it was really difficult because during that, we had this really good opportunity to buy this thing at a 36 cap. So fantastic deal, was performing amazing. Of course, it's not doing as well right now. But for 2 years, it just absolutely crushed it. And then, COVID hit, the oil hit, and there's been some competitors that have built up around it as well. But that was really hard to finance, just because RV parks are hard to finance because there's no infrastructure. So it's the collateral never meets generally the valuation of when you're buying these things. And then also it was just a kind of a mess out there in the Permian, and also in the underwriting, the documents that we got from the previous seller. Really good dudes. They just, from an organizational standpoint, to a professional lender, it was really hard. So we ended up going to kind of a debt fund, quasi hard money guy, and 96 hours before we were supposed to close, they ditched us. So I'll never say their name on a podcast, but if someone was to ask me, I would definitely tell them who not to work with. But at the end of the day, that's one of those things, going back to that planning that we do inside of Spartan. And we do something called a pre-mortem. So a lot of folks have heard of post-mortems or after action reviews. That's looking back on a failure and or even a success and seeing what happened. Well, I kind of believe an ounce of prevention is worth a pound of cure. So the pre-mortem actually looks forward and tries to identify potential failures, understand why they might happen, and then what you can do to prevent them from happening. Seems like a better way to do it than a post-mortem, right?
Absolutely. So
in our pre-mortem, we identified what we call the most dangerous course of action that a lender would take would be to pull out 96 hours before. We said 72 hours, so we actually gave ourselves 24 hours. But what we did is, when we saw that, we're like, well, how do we mitigate that? Well, if we have to, we'll raise our own private debt instrument from our investors, because at that point, that's all we got. So what we did is we engaged our attorney, and this was 2 months before this happened. We engaged our attorney to say, hey, what do we need to do here in Texas to make sure that we can raise this private debt? And the attorney was like, well, you just have these documents, and I'll prep them for you. It's a few $100. You'll have them if you need them. We needed them. So 96 hours before, we took a knee, put together a term sheet, put it out to our investors. 24 hours after that, had the money in the bank to close, went to closing, no harm, no foul. And at better terms than what the really bad debt people were offering us. So
nice. Good work. Good work. Now let's rewind this tape a little bit. Did you say 36 cap? 36?
Yep. 36 cap. So it's probably back to being a 36 cap. But for a while, I mean, it was doing really, really well. And it was an unfortunate story because the sellers, we're still friends with the sellers, just really good dudes, but they had a partnership that with some other family members, and it just wasn't really working for them the way it was going. So they wanted to offload it. And unfortunately, they were trying to offload it after, several years of kind of not great performance, both from an oil bust, but also just kind of mismanagement of the park, just because they had a key member of the family die and they were focused on that. And they were running their other businesses. Your quintessential story of just an asset that was neglected and provided a good opportunity for another buyer. Wow,
that's great. How many spaces was that?
So it started out as 102, and we put 14 new spaces in. So now we're at 116.
Wow, beautiful. Good job. Yep. On the same token, I asked you about your toughest. Now, in all fairness, what's been your home run? Maybe that was your home run too.
Depends on that's a matter of timing, right? So if you'd asked me a year and a half ago, what was the home run? It was goldenrod. It was just printing money. There was a guy in the back just printing sheets of money out, right? And everybody was doing really well. That guy quit in March and went home. So goldenrod is no longer printing money. It's actually eating money now. But so when we look at that, that's a matter of perspective. We've got a storage facility in Corsicana that's just doing fantastic. We've got an expansion going out there, and it's doing really, really well. And that's not, I don't know that it's a home run. I know we've had this a massive home run on the commercial space. We've just had good, solid assets that are performing very near where we projected, which is what you want to do.
Very nice. Now, you've been in this game. You've got some great wins. Any advice for somebody considering this asset, this investment? Where should they go? Your best advice you would share to the audience.
So, we get this a lot with individuals wanting to invest in storage. We're part of a bunch of different masterminds, and a lot of times we'll see high net worth professionals, pilots, lawyers, docs, dentists want to be I want to own storage. Okay, you can, but if you're running a practice and you're really good at that part of your life, you're probably not going to be very good at running storage. It's not something that you can do part-time. It's not a set it and forget it. It is an active business. It's not a 4-unit multifamily with 1-year leases. That's not how this goes down. So you have competitors and you have other operators like this. So I would say that, if you're an individual and you're going to get yourself into a storage, make sure that you are really spun up and you have the time to do it. Otherwise, invest with a syndicator like Spartan, or there's other ones out there as well. I'm not just advocating for us, but let your money work for you, learn the ups and downs of it. And then when you're ready to focus on it, then focus on it.
Beautiful. Thank you so much, Scott. Now, is there anything you're promoting, best way to reach you, anything like that?
So we're not promoting anything right now, but if people are interested in learning more about Spartan and they want to get into our investor ecosystem before something comes out, that's what I would recommend. They can go to our website at spartan-investors.com, and they can go through our investor intake, and they will talk to either Ryan or Ted. Both are just outstanding individuals that will walk them through and answer any questions they have. They can also dig in there and review our strategic plan, our portfolio of projects, and they can learn all about the Spartan team. If somebody has interest to get a hold of me, then please just email me, scott@spartan-investors.com.
Beautiful. Well, wow, Scott, this was amazing. Thank you so much for taking the time to share your words of wisdom. Thanks for your service for our country. Really, really appreciate you on the show today.
Thanks, Joe. Appreciate being here, and hopefully your guests find value in it.
Absolutely.